Hi, this is Pat with Energy Solution Partners sharing with you our energy market view on Wednesday, August 10th. Always keep in mind there is a risk of loss when trading commodity futures and options. As we digest the weekly DOE inventory report today, there's a couple items I would like to point out, and it does keep us positive, feeling positive about this diesel market, especially coming into the fall and the huge crop that appears to be out there. Looking at some of the stats here, the headline grabbed after the report today was the 1.1 million barrel build in crude oil, and that created some selling pressure, moving the markets lower. But I think there's some interesting statistics on the diesel side to look at, and especially here in the mid-continent or PAD 2 area. First of all, our total U.S. Diesel inventories are 2.3% ahead of year ago levels. So we are carrying a little more diesel inventory than last year at this time. But a couple items with that, our diesel demand does remain up 2 to 3% here in the U.S. And another interesting point here is the diesel production, as reported today by the DOE. And that production is down 7.9% from a year ago. So, with these refineries slowing down a little bit here, that kind of cut in production, we'll whittle away at this little surplus that we have compared to a year ago. And this drop in diesel production is likely due to the poor crack spreads and less profitability running these refineries, which last year at this time, the diesel crack spread was in the $20 per barrel range compared to today at $13 a barrel. And then digging in further, looking at our mid-continent area here, our diesel inventories are down 4.2% from this point a year ago. So coming into this fall harvest season with a lot less diesel inventory, and also the PAD 2 refinery runs are down 5%. From where we were last year at this time. So doesn't look like we're going to be cranking out a lot of product here as we move into this fall season. And with that, I guess these factors have us feeling that the upside risk in the diesel market is probably even more so on the cash basis than what we expect in the futures market. And as we look at some rack basis here, I pulled up the Minneapolis rack, and what this basis number is telling us is what the rack price was minus where the NYMEX contract was. So last year at this time, we could see that Minneapolis terminal did jump up in the 20 cents over the NYMEX area, came back down in the 10-cent range. But then coming into September and October, we seen that take a run again up in that 20 to 25 cents over, and then even a big spike in November where we went to 30 cents over the NYMEX on the diesel rack. Madison rack, so this would be Chicago market where the Minneapolis is focusing on the group market, but kind of the same numbers. Year ago, we were watching these rack levels in this 15 over range with a spike in October. We got up to 50 cents over the NYMEX, and so that's where we say the rack price outpaces what the NYMEX future does, and you can protect against these type of spikes by doing fixed forward contracts and locking in that price. And I guess that's a recommendation that we do make here coming into fall, with the outlook again of inventories below year ago levels. We're setting ourselves up, I think, for a strong cash market coming into fall. Just to give you a rough idea where some of these contract basis numbers are running, and again, looking back at last year's spikes in that cash market, the basis can be bought today in the 10 to 13 cent a gallon range for fall contracts. And so if you'd like to get some contract quotes and look at putting some pieces together, we'd love to visit with you about it. So feel free to give us a call. Thanks and have a great day.